So today we have a series, I think, to do here. I mean, are you guys able to hear Mwalimu really? Are you guys able to hear Mwalimu? Or is there a problem? Are you guys able to hear Mwalimu? No? Okay, great. So then let's start now. Very okay, thank you. So then I want us to look at adjusted present value, APV. This is what we are looking at today, APV. If you have this book, I would want you to basically write there. It's page number 250, page number 240. Yeah. Page number 239. Page 239. ACCA, AFM. I think these books are two. There is the open edition one, and then there is a Kaplan. This is Kaplan. I don't know whether I've given you the Kaplan text. I don't know whether I've given you the Kaplan text. If I haven't, I'll be able to give it to you. No worries, it will be US. No worries, it will be US. So you're told here the basic principle. The APV method evaluates the project and the impact of financing separately. So whenever we hear of the word APV, adjusted present value, ladies and gentlemen, this will always evaluate the project. They get the NPV of the project and the impact of financing separately. Hence, it can be used if a new project has a different financial risk, what we call debt equity ratio from the company, i.e., the overall capital structure of the company changes. So APV consists of two different elements. APV consists of two different elements. We have APV value of a geared project equals base case NPV, plus financing impact, which will be the present value of financing side effects. Listen. Whenever they want us to give them APV, ladies and gentlemen, this is the easiest topic. You'll be able to have it. This is the easiest. The sound has a problem. Are you sure you guys are not able to hear me? They're saying it's okay. They're saying it's okay. Perhaps it is only, maybe we should be able to look at, or they're saying, please check your side as well. So in this case here, they are saying here, APV equals base case NPV plus now financing impact. So anytime we talk of APV, give me a minute. Okay, so anytime they talk about APV, we will always get what we call the base case NPV. APV equals base case net present value plus, in this case here, the present value of financing effects. So PV of financing what year? Effects. I hope now you're able to hear Mwalimu. All right. And I'll be able to share the book with you. Now, don't ask so many questions. I'll share the book with you as we continue. We have very limited time. Now, ladies and gentlemen, for us to be able to understand and get to really benefit most out of this, please check this. how do we get this base case NPV? How do we get this base case NPV? The project is evaluated as though it were being undertaken by an all-equity company, with all financing side effects ignored. The financial risk is quantified later in the second part of the APV analysis. So dot number 1 here, ignore the financing risk in the investment decision process. And then number 2, use a beta that reflects just the business risk, what we call the beta asset. We would understand this. So look at the steps here. Find the project beta asset. Then number 2, calculate the base case discount rate, K, by putting the B asset in the CAPM formula. And then you calculate the base case net present value, the base case net present value. Ladies and gentlemen, this is a very straightforward question. But before we go to this, there is something small that I would want to draw your attention to. The financing impact. Financing cash flows consist of issue costs and tax reliefs. As all financing cash flows are low risk, they are discounted at either the KD or the risk-free rate. So we look at examples here. Examples of exam tricks on APV, adjusted present value. So adjusted present value tricks. In exam questions, you may see the following tricks when calculating the financing impact part. All these tricks are covered in the next test your understanding questions. The first trick is how to gross up, grossing up. So in this case here, grossing up. So we are looking at grossing what here? Grossing up. We are looking at grossing up. So we are told here, a firm will know how much finance is required for the investment. How much finance is required for the investment? Issue cost of financing will usually be quoted on top. It will therefore be necessary to gross up the funds to be raised. Please, ladies and gentlemen, listen. Assuming we have a situation here at RCM, we are looking, in this case here, for what year? We are looking for 800, we are looking for, say, 900,000. We are looking for 900,000. So this is the loan we want. And then, ladies and gentlemen, when you go to Equity Bank to get this loan, Equity Bank will not, in this case here, give you this cash just like that. There are issuance costs to these loans. For example, you must pay the legal fee. For example, in this case, you must pay insurance. So if you want exactly 900,000, then the issue cost, for example, may amount to 150,000. So in short, ladies and gentlemen, you will end up borrowing how much here? You will end up borrowing 1050,000, and then of course they will be left with 150,000. They'll be left with 150,000. Is now my sound a little bit better? Is my sound a little bit better? Is my sound a little bit better? Ah, okay, great. So please listen. Then the total loan here will be 1,050,000 because we have to top. So issue costs are always on top. That is the most important thing that you're supposed to remember. Issue costs are always on top. So Winnie is saying no, but now I can see most of you are saying yes. So it means it is on Winnie's side. The mistake is on Winnie's side. The problem, not mistake. The problem. Now, ladies and gentlemen, please listen here. So we are told here, grossing up illustration. The finance required for a planned investment is 2 million. Net of issue costs. Issue costs are 3%, and the finance raised will also have to cover the issue costs. Then what are the issue costs and what sum will be needed to be raised? Now, ladies and gentlemen, we want to raise, how much do we want to raise? We want to raise 2 million Kenya shillings. We want to raise 2 million Kenya shillings. So to raise these 2 million Kenya shillings, this is what we are doing. To raise the 2 million Kenya shillings, we have gotten a ninja who wants, of course, to organize the 2 million. We get net of 2 million shillings. We need to pay an issue cost of 3%. Issue cost of 3%. Issue cost of 3%. Is there any good ninja who can give me the amount of issue cost here out of this 2 million? Amount of issue costs. Let's see these ninjas. Amount of issue costs, question mark. Is there anybody who is able to give me? Maybe the light is too much as well. Stacy, have you finished?
Yes.
Is it possible you guys to sign off the internet? Mine is not able to teach. Yes, I also tell the other guy to sign off. Oh, they are giving me 60,000. They're giving me 60,000. Brilliant, brilliant. 60,000. Can you kindly put a big wrong there? Put a very big wrong there. A very big wrong there. Put a very big wrong there. Put a very big wrong there. All right. All right. So does that mean that he borrows 2060? Does it mean that he borrows 2060,000? So do you want to tell me that if this is 60,000, he borrows 2060,000? Is that the case? Because he would want to be left with 2 million. Would want to be left with the 2 million. Frida is putting like this. Frida is putting like this. Ladies and gentlemen, I would want you to always remember this concept here, that the 2 million is net of 3%. So this is net of 3%, net of 3%, i.e. it is at 97%. It is at 97%. So this 2 million is at 97%. So then if 97% equals 2 million, how about 100%? That's how it grows up. How about 100%? How about 100%? Please do the tata abracadabra. Please do the abracadabra. Do the abracadabra. Are you able to do the abracadabra? If you cross multiply, how much shall we get? 2. If you cross multiply, you can even omit the percentages. So if you cross multiply abracadabra, this would be 100% times 2 million divided by 97%. Is there somebody who is able to give me this figure? Quite an ugly figure. Quite an ugly figure. 2061, 856. 2061, 856. 20. But this is 20, 20, 20, 20, 61, 2061, 856, something like that. So this is the gross amount. The gross amount. And therefore the issue cost will be equal to how much? The issue cost will be the 2061, 856 minus the net. You see, we'll be given a net of 2 million. They will give us a net of 2 million. They will give us a net of 2 million, which gives us what amount here, ladies and gentlemen? Which gives us what amount here, ladies and gentlemen? 61, 61, 856, 61, 856, 61, 856, 61, 856. Please let me repeat this again. Allow me to repeat. Allow me to repeat this concept. Allow me to repeat this concept. Ladies and gentlemen, whenever you go to an exam, so can I wrap this fast? Can I wrap this or I give you a minute to write something? Today's not like yesterday. Today's marathon. Today's marathon. Today's marathon. And I want to assume there is nobody who has already eaten ugali. Nobody has eaten ugali. Nobody has eaten ugali. Now, ladies and gentlemen, when they tell us that these 2 million, the 2 million is net. The 2 million is net here. All right. So if 2 million is net of 3%, if it is net of 3%, it is at 97%. It is at 97%. And therefore, the issue cost will be 3% over 97% times 2 million. That's how we get the issue cost. 3% over 97 times 2 million. Times 2 million. The issue cost, yes. Now we're getting issue cost even using a better method. Using a better method. So is there somebody who is able to confirm that this answer will be the same as the other one? Is there somebody who is able to confirm that this answer is the same as the other one? Thank you so much. Thank you so much. And if you look at this book, ladies and gentlemen, they also have the same. If you look at this book, ladies and gentlemen, they have your 61, they have your 61, 856, 61, 856. I can't proceed before you guys confirm that that part is clear. Is that part clear? Is that part clear, ladies and gentlemen? Is that part now clear? Especially this shortcut. It is a shortcut that I would want you guys to master. It is a shortcut that I would want you guys to master. Thank you so much. Thank you so much. Great. Ladies and gentlemen, please let's move on to something very, very nice. So present value of debt issue costs. Debt issue costs. So this is very easy. I should be able to look at an illustration. An illustration. This will really assist us here. Look at this illustration. We have been given a loan of $400,000. This $400,000 is to be borrowed for 3 years and repaid in equal installments. The risk-free rate is 10%, and all debt is assumed to be risk-free. All debt is assumed to be risk-free. Calculate the present value of the tax relief on the debt interest if the corporation tax rate is 30%. Assume that the tax is delayed 1 year. Assume that the tax is delayed 1 year. So 400,000 is to be borrowed for 3 years and repaid in equal installments. That is where we have the catchword. Repaid in equal what year? Installments, and repaid in equal installments. So, ladies and gentlemen, what do you think really is this examiner after? Will they tell us that this 400,000 will be repaid in equal installments? It can't be 400,000 divided by 3. We have the factor of what year? Interest in this. Ladies and gentlemen, here, they want us to give them a loan amortization schedule. They want us to calculate this annuity. They want us to calculate this annuity and give them what we call a loan amortization schedule. How do we get this loan amortization schedule? Because of the interest. You know, if there was no interest, then the equal amount payable every year, it would have been 400,000 divided by 3. But you see, there is an interest element in it. So you have to pay more than that divided by 3. You have to pay more than that divided by 3. So here they want us to give them what we call a loan amortization schedule. A loan amortization schedule. So then how do we do this? To be able to do a loan amortization schedule, we need what we call the installment amount. Installment amount. Is there anybody who is able to tell us, how do we get this installment amount? Is there someone who can remind us? How do we get this installment amount? Thank you so much, Winnie. Amount over PV-FA. It is amount over PV-FA. It's amount over PV-FA. So I don't have a problem with the amount. I know amount is 400,000, but PV-FA, I've got every problem with PV-FA because I know PV-FA. There are very few students who will be able to get PV-FA right here. Very few students will get PV-FA right. Let me return the question back. There are very few students who will be able to get PV-FA here. Remember, they have given us the risk-free interest rate here is 10%. And all debt is assumed to be risk-free. Calculate. So, ladies and gentlemen, remember it is 3-year loan. And now the rate of interest really is what here is 10%. The rate of interest is 10%. So you want PV-FA 10% for how many years? For 3 years. 10% is on your table there. There is a table called the annuity table. You go there and read. You don't have to tell the examiner that you want to flex the muscle and show the examiner that you are really a very, very strong. No. If the percentage is on the table, you read it from the table. Read from the table. Like I can see Juliana, 2.4869. 2.4869. Is that okay? 2.4869. Are all ninjas comfortable? Remember, ninjas, we have to be very truthful. Whenever I want to rush, really, you have to be very truthful. So are all the ninjas in this case here able to get this figure? All the ninjas able to get this figure? Thank you so much. There's nobody who has a problem. All the ninjas are able. So remember, the amount is 400,000. The amount is 400,000 divided by this PV-FA like that. So then is there somebody who is able to give us, ladies and gentlemen, the installment per annum? So you can see if we divided here by 3, I would have gotten a smaller amount. But because of the interest, and they have told me this thing is going to be paid in equal installments, then I have to get what we call the installment using the PV-FA method. So they're getting 160,843. They're getting here 160,843. Now, I would want to know, ladies and gentlemen, out of just curiosity, when you have that installment, the repayment amount of 160,843, do we have any serious ninja here that can do a loan amortization schedule from the beginning to the end? Because if we're going to get a question of APV, then this will be there. If we shall get a question of APV, this will be there. I can see so many yeses there. I can see so many yeses there. So would you want to tell me that I should skip that totally? I would be very happy. Is there any ninja who does not know? Is there any ninja who does not know how to do a loan amortization schedule? Any ninja who does not know how to do a loan amortization schedule that would want my help? Please, ninjas, talk. If you're not talking, I'll not be able to help you. Yeah, Maggie says yes. Then let me do it. Thank you so much. I like ninjas who are giving me work to do. So then what I'll do, so long as I have my headings right, then I will be halfway correct. I'll be halfway correct. Headings are everything here. So then we have the time here. So time we have 1, 2, 3 years. So we have in this case here opening balance. So we have the opening balance. Opening balance, of course, will lead to what we call interest. Then we have in this case here the installment. The installment, remember, this is our repayment. This is our repayment. Then we have in this case here closing. We have closing balance. So ladies and gentlemen, really armed with this, I mean, I'll get everything. So then, what do you think will be the opening balance? No, this is not a very good ninja. This is not a very good ninja. Langat Amos ajui anasema ati we know, but let us do it together. Ujui. Lakini maybe utakumbuka Amos Langat after nimefanya namna gani nimeandika hizi titles. Wanafunzi na msemo wanajua. Lakini ukienda kwa mtihani unaona hizo titles zinatoka kwa kichwa, zina evaporate. Inawasumbua sana, but we shall overcome. So in this case here, the opening balance is the very first, not 160 uongo. Opening balance is the total loan, you guys. And the way you told me that so many of you can do it. Opening balance is normally the loan that you've been given. It's normally the loan that you've been given, 400,000. So, so let's levy interest on this. Do you know the rate of interest? The rate of interest is 10%. So opening balance always earns an interest here. So 10% of 400,000 gives me 10%. Is not different. The only thing that you realize with the AFR is that you'll be given this installment, like if it's leases, you'll be given that 160,000. If it's AFR, they'll give you that amount because we don't calculate the installment, but you should be able to go back. So 40K, thank you very much, 40K. Then how much are we going to pay you ninjas? How much is the installment? How much is it? 168.43. 168.43, and this is normally constant. This is normally constant. Oh yeah, this is normally constant. Sijui kama umeanza kukumbuka sasa. Sijui kama umeanza kukumbuka. Oh yeah, umeanza kukumbuka sasa, tutakuonyesha installment inafaa ikuwe same. All right. So then come and give me the closing balance for year one. Closing balance for year one will be opening plus the interest minus this repayment, which Madam Hilda has been able to, even Frida Ngatia leo ako sawa sana. Frida Ngatia leo Frida Ngatia ni kama ameanza leave, ameanza kusoma. Frida amesema ni 279, 157. 279, 157. This is what I put here. 279, 157. 279, 157. Let this figure earn interest. 10% of it. Just give me a whole number. Hilda has given me 27,916. 27,916. So take this plus this minus this. Abracadabra. So we have here the closing balance for year number 2. We are taking this plus this minus that. What figure are we getting here? Somebody 146, 230. 146, 230. Unakuja hapo unasema 146, 230. Let this figure earn interest. Let it earn interest. 14,623. It's a 10%, remember. 14,623. How do we get the closing balance? We shall take the opening balance, we add the interest, and then we deduct, in this case here, the repayment. We deduct the repayment. So what are we getting, somebody here? Even if you're getting some, I'm so sure you're not getting zero, but you guys are geniuses. You're only getting zero, but you know that it should be able to amortize to zero. It should be able to amortize to what year? To zero. It should be able to amortize to zero. You can see here, like them, they got 32. I'm so sure there must be a ninja here who also got around something like that. But they're telling you that the difference is due to rounding. Otherwise, we should be getting what year? 0. Otherwise, we should be getting a 0. Otherwise, so don't write that 32 or 20 or whatever. you need to get exactly what you guys got exactly 0. We got exactly 0. Allah. Somebody got 10 there. Great. But don't write that 9.9. Examine our customer, ukiandika hiyo kitu hapo atakunyorosha. Namna hiyo. Sasa, one of the things that you will be required here to appreciate is the present value of the interest. So what we call the interest tax shield. Interest tax shield. So I would want you to prepare something here, another table of interest tax shield. Interest tax shield, very easy. So we have year 1, year 2, year 3. We have year 1, year 2, year 3. My students are complaining here. Background noise, Britton. All right. The screenshot, okay. Sorry, Ellen. All right. So, ladies and gentlemen, I hope this ninja is able to see the question now. Please take a screenshot, and I'll be sharing this book with you. I will really give you guys a lot of resources here. I will give you a lot of resources. So the ninja wanted me to share like that. Has he been able to screenshot the question? Screenshot the question. Has he been able to do that? Has he been able to do that? Has he been able to do that? All right. All right. All right. Now, ladies and gentlemen, are you able to hear me now very clearly? Let's first of all respond to that. Are you able to hear me very clearly? Are you able to hear me very clearly? Clear. Clear. All right. So then come here and give me, ladies and gentlemen, the tax, the interest. So we have here the year, we have here the years. So our years are 1, 2, 3. Give me the interest amounts. So interest amounts, we have 40,000. This one here is 27,916. This one here is 14,623. We know that our rate of taxation there is 33%. 33%. This was a good examine. I don't give students always 30%. So they give me the interest tax shield. ITS, interest tax shield. Two things that you must always encounter whenever you're doing a question of APV. You'll get that concept of the interest tax shield. Interest tax shield, you get it. And then number 2, you'll need what you call depreciation tax shield. Depreciation tax shield. You will get depreciation tax shield. You will get depreciation tax shield. It is 30%. Where did I get that? It is in the subsequent question. I'm sorry. It is 30%. I'm so sorry there. It is 30%. It is 30%. So as you curse me, just change it there. 30%, 30%. Never curse your teacher. So is there somebody who is able to give me this interest tax shield now? Interest tax shield. The kind of shield, the kind of benefit we shall get by the fact that interest is tax allowable. Because interest is tax allowable, there is a clear benefit there. There is a clear benefit there. So the benefit, you can also call it the tax benefit on interest. So this one is giving me 12,000. 12,000. How about year number 2? How about year number 2? How about year number 2? 8375 winning. Winning is winning here. 8375. And then we got the last one. The last one, what do we have? 4387. 4387. 4387, like that. So please write this in full. It is interest tax shield or interest tax benefit. Even a shield is to confuse students. It is interest tax benefit. But you see, I'll be receiving these monies when? In the future. Then I would want in this case to do what? To discount this. I would want to discount this. I would want to discount this. I would want to discount this, ladies and gentlemen. So what do we have here? What have they told me about discounting? They've told me, of course, in this case here, for discounting purposes, I will use the cost of capital given. I'll use that 10% still. But you can see this thing. Assume that tax is delayed 1 year. Assume that tax is delayed 1 year. Whenever tax is delayed 1 year, there are many ways of doing this. I like the approach here. With the tax being delayed by 1 year, the approach is very good. Look at what they have a column here for timing of tax. Timing of tax. They have a column here for timing of tax. I like this. Timing of tax. Timing of tax. I liked this so much in the morning when I looked at this question. So if this value is being delayed 1 year, it's 1 year in arrears, it means that year one's cash flow, year one's tax will be paid in which year? Year one's tax will be paid in which year? The following year. The following year. So then this tax, if it's any tax, assuming there's any tax associated with this, it will be paid in time 1 or year 1. Year 2, this will be paid in time 2. This one here will be paid in time 3. Time 3. This one here will be paid in time 4. Time 4. Because we are in this, ladies and gentlemen, what is happening here is the fact that whatever that we have here, there is a delay. There is a delay. We are delaying this and paying next year. So then can you kindly go ahead now, because these amounts are different, go ahead and give me the PVs. Go ahead and give me the PVs at 10%. So this will be 10% year 2. This will be 10% year 2. Abracadabra. The first one here will be 10% year number 2. From your tables, good ninja. From your tables, good ninja. So this is 0.8264. 0.8264. 0.8264. Thank you very much. How about 10% times 3? 10% times 3. 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 75, 13. 75, 15 or 13. 75. 75, 13. And then we have in this case here 75, 13. Yes, 75, 13. 75, 13. And then lastly, ladies and gentlemen, what do we have here? Lastly, we have 0.6830. 0.6830. 0.6830. So then are you able to give me the present values? Is there somebody who is able to give me the present values? Is there somebody who is able to give me the present values here? Is there somebody who is able to give me the present values? So you take this times 0.8264, give me an answer I write. The second one, give me an answer I write. 9917. 9917. All right. How about the second one? Take 8375 times 0.7513. How much do we have there? 6292. 6292. 6292. How about the third one? You take this times 0.6830. That gives me 6291. All right, already in 2996. So I would want to repeat this, but before I repeat, are you guys able to give me the total here, ladies and gentlemen? Are you able to give me the total present value of the interest tax shield? Total present value of the interest tax shield. Total present value of the interest tax shield. 19205. 19205. You can see this is what this ninja has as well. This is what this ninja has as well. Of course, because of rounding off errors, they are getting 19.1. That's pretty similar to ours. Pretty similar, because then they're rounding here to 3 decimals. So we are even more accurate. You can see what Alango wants me to do. Alango wants me to take this old approach of mine, which is still good enough. So Alango wants me to come and write this like this, which is still good enough. Pretty good, really. So we have our 3 years, 1, 2, 3. But because of the 1 year tax in arrears, we are going to give birth to year number 4. Give birth to year number 4, a new year. And then the tax benefit in year 1 will be gotten in year what? In year 2. So instead of putting this tax benefit here in year 1, I bring it straight away to year 2, the same, 12,000. This one here goes to year 3, 83.75. This one now here goes to year 43.87. And then of course here we have now nothing, 0. Then you come and give us PV at 10%. PV at 10%. So is there somebody who can give me these PVs very fast? We can start even with for time 1 so that you can the guys can revise easily. So what is the PV 10% time 1 from your tables? From your tables, abracadabra. 1991. Woi niko peke yangu lakini I will overcome. 1991. How about PV 10% year 2? Niko nazo hapo already. Zile. Niko nazo already. Si kweli? I have them already. 0.8264, 0.8264. Then we have here 0.7513. Then we have here 0.6830. So please go ahead and multiply. Go ahead and, so this is method 2. This is method 2. So go ahead and multiply to get, in this case here, the present values. This will be 0. Here, this will be 9917. 9917. This one here will be 6292. This one here will be 2996, giving us what total? Total PV of interest tax benefit. Interest tax benefit. You guys are giving me some total here, which was 19 something, 100 and something, 100 and something. You guys are giving me a figure there of 19205. 19205. So which method do you think is better? I think our old method is, but I think this method 2 is much better. I think method 2 is much better. I don't know why my mind in the morning took me to this, which told me, my mind telling me that this first method, I think this second method is better. Second is better. I would want to go with second, because that is what we are using to. Now, ladies and gentlemen, then I've been able to lay down the foundation for APV, and then I should be able to go to an APV calculation question now. Test your understanding too. So are we ready now for APV questions? I will be able to repeat most of these things that we have done here. I'll be able to repeat most of these things we have done here. So are we ready, ladies and gentlemen? Are we ready? Are we ready for this exercise? We are told the rounding company is a company currently engaged in the manufacture of baby equipment. It wishes to diversify into the manufacture of snowboards. I'm getting a situation where, ladies and gentlemen, and this is very popular. You guys will get this question in your exam. I'm getting a situation where, ladies and gentlemen, our firm RCM wants to go to venture into a new industry. So when you hear of a question talking over us going to a new industry, what comes to your mind? What comes to your mind? When you hear of a company going, in this case here, to a new industry, what comes to your mind? Hey, you crazy great ninjas, what comes to your mind? 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 Growth, I doubt. Hamada's model. Hamada's model will be used. Because the very first thing you need to do is to ungear. You go to the new industry, you ungear it. You go to the new industry, you ungear it. You ungear it using the Hamada's model. You ungear it using the, thank you very much, Esther Mutinda. It is Bell, it is Bell, it is Bell, it is Bell, Bell, Bell. Thank you very much for making good guesses. But you can see your guesses today were not very, are they correct? Those guesses you made. Were they correct? This concept of new industry, the guesses you made, were they correct? Of course, someone who spoke about risk, I can agree somehow, but whenever you hear of a new industry, you must always think about great things. Compare more so. You must think about Hamada's model. You must think about, in Hamada's model, you have the bell thing for the new industry. Not sure. But I've explained now, you should be sure you are wrong, Purity. You should now be sure that you are very wrong. Great. Now, ladies and gentlemen, from that, I would want us to go straight away to the second, the investment details. The company's equity beta is 1.27, and its current debt to equity ratio is 25.75. However, the company's gearing ratio will change as a result of the new project. Firms involved in snowboard, this new industry are going to manufacture, have an average equity beta of 1.19 and an average debt to equity ratio of 30:70. Assume that the debt is risk-free, that the risk-free rate is 10%, and that the expected return from the market portfolio is 16%. Now, ladies and gentlemen, the new project will involve the purchase of new machinery for a cost of 800,000 net of issue cost, which will produce annual cash inflows of 450,000 for 3 years. At the end of this time, it will have no scrap value. Corporation tax is payable in the same year at the rate of 33%. The machine will attract tax allowable depreciation of 25% per year on reducing balance basis. So you can see we have a reducing balance depreciation with a balancing allowance at the end of the project life when the machine is scrapped. So, ladies and gentlemen, what do they want us to do? They want us to do great things here. They want us to do great things here. I don't know why they haven't asked a question, but it's here. calculate the adjusted present value of this project, the one that is in yellow. Calculate the adjusted present value of this project. That is an examiner who is wishing me success, and I will be able, ladies and gentlemen, to get all the marks. Is there a student who has that feeling that this kind of a question, if it came in an exam, they would get 16 over 16? And of course, with the theory up there, so they'll get 20 over 20. Is there somebody who has that kind of a feeling? Even that question, I mean, don't do it. That's a straightforward question. Okay, let me not pose it, the question that way. Is there anybody who feels that, I mean, here, if I want to get everything, there are very, very many low-hanging marks. And if you are saying yes, tell me the low-hanging marks. Tell me the low-hanging marks there. Richard, I'm imagining Joe, is it Joshua? I'm waiting for someone to tell me the low-hanging marks. I calculate Bell, okay. 12, Esther Mutinda, then you must be very good at this. You must be very good at this. I'm waiting for the other ninjas in this case to talk for sure. I like what Esther Mutinda is saying there. She may not be able to get 16, but she'll be able to get 12. Do you know why 12 will come here? Unlike AFR, where workings don't matter so much, you know, AFR workings don't matter so much. AFM, workings are everything. Workings can take you to places that you've never seen before. Workings can take you to places that you've never seen, in this case here, where before. The very first thing I will do, ladies and gentlemen, is not to get Bell, is not to get what you guys are getting there. The very first thing that I will do here, I've heard they are talking about depreciation. And this question happens to be having a taxation rate. And because it has got tax, then automatically depreciation is relevant. So the first thing that I need to do is to compute depreciation. That's a free mark. Depreciation. That's a free mark. Depreciation. This one I'll put aside. Remember, this depreciation is reducing balance. Oh, yeah, these are good examiners. I love this kind of examiners. These are good examiners. So depreciation will start with year number 1. The machine is worth 800,000, isn't it? The machine is worth 800,000. And in this case here, the depreciation, they have told us, the depreciation they have told us is, what there? The depreciation, you know, the machine. The new project will involve the price of a new machine at a cost of 800,000. And depreciation they have told us is 25%, reducing balance. Depreciation is 25%, reducing balance. So then year number 1 will be 800,000 times 25%. Is there somebody who can give me this figure? Is there somebody who can give me this figure depreciation for year number 1 as other students are looking at the ceiling board? I'm not looking at the ceiling board. Myself, I'm writing numbers here. So somebody is giving me a figure of 200,000. 200,000. Then we go to year number 2. Remember, it's reduced balance. The reduced balance here will be 800,000. 800,000 minus 200,000. Whatever we get times 25%. Whatever we get times 25%. Whatever we get times what? Maria Lizzie, 150,000. Ladies and gentlemen, from there we go to year number 3. So in year number 3, what is going to happen? For year number 3, what is going to happen? There is a student who can't see anything. I don't know why. Jane Kari can't see it. Are you guys able to see things here? Are you guys able to see things here? I've not even shared anything on the screen, so she should be able to see. So if you guys are able to see, then Jane Kari, it is your network. Yes, it's your network. It's your network. Change the provider. Use bundles now. So they're giving me, these guys are very bright. They're telling me in this case here, ladies and gentlemen, that the final answer should be Leslie. According to Nderi, the final answer should be 112.5. 112.5. 112.5. Ikiwa ni Mkikuyu unafanyia hivyo, atakwambia we neke maheni. Because this project has got 3 years. And if the 3rd year is the last year, we don't apply the percentage. We're going to use the balancing allowance method. The last year, we don't apply the percentage. Oh yeah. The last year, tunaangalia imebaki shiga na. Tunasema hapa ni 800,000. Tulianzia 800,000. Tuka lose 200,000 in year 1. Tume lose 150,000 in year 2. Sasa year 3, hakuna kusema ume lose nini. Year 3, you don't also apply the percentage, but you must always remember to deduct the scrap value. You must always remember to deduct the scrap value. Year 3, you must always, don't forget. You don't apply so many things, but you must always remember to deduct the scrap value, of which they told us here, it will have no scrap value. It will have no scrap value. It will have no scrap value, which gives me 450,000. 450,000. Wanafunzi wale wa 112, wale ambao walikuwa wameshawaramba tayari, have you learned something here? Have you learned some new concept? Because if you miss depreciation, most of the other subsequent workings will be wrong. Because you can imagine what will happen to your cash flows. Wrong. We shall overcome. Ladies and gentlemen, from there, then what I will do, if I'm the one doing this, then I will be able to come and give them the depreciation tax shield. I'll just come here and give them depreciation tax shield. Let me see whether it is acting of 1 year in arrears, so they can, last year, all right. So let's see whether they are paying 1 year in arrears, the tax. Where is the information about corporation tax? Corporation tax is payable. This is an easy examiner, a good ninja, a ninja they can walk around with. Corporation tax is payable in the same year at the rate of 30. So in this case, in the same year, tax being paid the same year. So times 33%, times 33%, times 33%, times 33%. In this case here, then what are we going to get as our depreciation tax shields? So depreciation amount times tax shield. We call this one DTS. The other one is ITS, or depreciation tax benefit. How I wish I had good ninjas who are giving me these figures very fast. How I wish I had good ninjas who are giving me these figures very first. What do we have according to Ninja Paul? This is 66,000. 66,000. And then we have in this case here, second year, Maria Lizzie. Great. So Rose M alikuwa amepotea sana. Rose M sasa amerudi na fujo, which is very good. 49,500. Year 3 tax shield, year 3 shield be 350k ama 350k. Kwa nini? Tumia calculator. Ama umechukua namna gani? Because it's 800,000 minus 200,000 minus, already this is 350. So if you take away 350 from 800, it will be 450,000 times that 3,000. It will be 148 what year? 500. It will be 148,500. 148,500. So this is a final answer, 148,500. We need the depreciation for year number 3 is straightforward. You take in this case here the amount you started with, 800,000, minus what you've been able to lose in year 1, minus what you've lost in year 2. Given that year 3 is the last year, then you subtract, in this case here, the scrap. So you don't put like any percentage there. No percentage at all on the last year. So 148,500, that should be the answer. Let's check whether you are correct. It's always good to check. And I've taught these things severally. So this is very good. Now we have the answer here. You always open 2 tabs. And then you look what you're doing here. Very nice. Life is very good. So tax in this case, you can see tax, allowable depreciation computation. You can see what they have here, 6650, 149. So we have ours in 149 like that. So it's still good enough. All right. We don't want these things of timing now. We hate them. We don't like them now. Now, ladies and gentlemen, after that, then I would want us to, now after I get this depreciation, now I'm at home. I'm very happy and settled in my heart. Very happy and settled in my heart. So I know that getting now cash flows will be a walk in the park, and then I'll be able to discount them now using KU. So remember, for APV, base case, NPV calculations, use KU to discount cash flows. To discount cash flows, we shall use what we call KU. KU is cost of equity over unlevered firm. Cost of equity of unlevered organization. Cost of equity of unlevered organization. Cost of equity of unlevered organization. So I don't know whether up to there we are together. Is it my network? I can't see Mwalimu. I can't see Mwalimu. Have I disappeared? Have I disappeared? Have I disappeared? Have I disappeared? Or I should come live like this. Have I disappeared? Are you guys? Or you are able to Niko sawa. Niko sawa. Mwalimu is very visible and is dark and handsome. Dark and very handsome. All right. Now, ladies and gentlemen, in this case here, Allah, also Rani can't see me. It's many people can't see me. Oh, Leonet now some yeah. So remember we've said that base case NPV, we shall assume that this company is debt-free, is financed through equity, debt-free. And if it's debt-free, then its cash flows will be discounted using what we call K. Now from there, then, we are looking for this K. So to get this K, what do we do? So first, we ungear new industry. We ungear new industry using Hamada's model. We ungear using Hamada's model. And we know how Hamada's model looks like. Same here. There's a problem, I think, somewhere. There's a problem somewhere. There is a problem somewhere. So, ladies and gentlemen, using Hamada's model Bell equals BEU into 1 plus D over E less tax, like that. Less taxation, like that. I think, ladies and gentlemen, today people have had so many problems. If we stop here, I think it will really be good for everybody. And then now when we come tomorrow, people should be able to do what here? People should be able to at least. So, and I want to take this opportunity to thank you guys very much. You've really given us many students to do this secondary school tuition with us. Many of you have given me their sons, their daughters. I never knew that you guys have children in secondary school. That is very surprising. Like Onderi here. All right. I've always been thinking that I'm teaching people who are 23, 24 years old. All right. That is so good. So please ensure that ensure that if you are here and you have a daughter, you have a son, you have a sibling, a friend of a friend who has somebody in high school, please give us those children for mentorship and a proper tuition. We are charging in this case here 4 papers, 4,800. That's for 3 weeks. That's mathematics. We have mathematics, physics, chemistry, biology, 4 papers. So 4,800. So if you're doing like 2, it will be divided by 2. And you can pay this amount on a weekly basis. Very, very easy. If you have somebody like that and you want to promote your Mwalimu, this is our number, 0793 555 000. But I'm really so happy because starting such kind of a project and you get over 100 young people is a nice thing. Thank you so much. Be blessed. Bye. The Kaplan book, yes, I'll share right now. Do I share it here? Do I share this book here? Let me just share it here because if I promise to share